Good evening and welcome to the FiTT Show. Financial information for today and tomorrow. I'm Bobby P. Kinzer, and my partner Thomas Doty should be appearing at any time now. Voila! There he is.
You
Like
just
that.
say it and it happens, my brother.
Say it again.
You just say it and it happens.
I like that. I like that. I'm glad to hear that. I wish that worked with a lottery number. So welcome everybody. Today is the 25th of September in the year of our Lord 2025, and we have another great show for you. Last week we talked about quotes from the wonderful Warren Buffett, quotes to live by, and this week we want to talk about moves to make when the rates drop. And the rates did drop 0.25% by the great Federal Reserve, the central banks, and we're going to talk about that and how it can affect you and some of the moves that you can make. Before we get into that, just want to give a couple of administrative duties I must have. We must give a disclaimer that we are not fiduciaries or financial advisors, and we are financial educators, and we provide information to you that you can use, but we always add, make sure you seek a qualified investor for specific information that pertains to your particular portfolio. And also, we like for you to click to the like button and the heart button, because that gives us access to more people. That's how at least Facebook works. And then we like for you to share. We like for you to make sure you share on Facebook Live and on YouTube. We like for you to subscribe. Go out there and subscribe. And come on, tell as many people. We're up to, I think, close to 500 people that follow us now. So we're doing pretty good. Must be doing something right, though. This is our 214th show. So like I said, we must be doing something right. But we also like your comments in the comment box. And actually, the comment box is kind of special because me and Dodie are in the studio where we are in our homes. But this way, we could be interactive by using the comment box. If you had any opinions or anything we're talking about, questions, or you have some topics you like to talk about, or you saw something that was a particular interest to you, put it in the comment box. And plus, the more things you put in the comment box, that works even more than clicking on the like button. If for some reason there are greater algorithms that allow you to reach more people. So we appreciate, when you put something in the comment box. But, use it. And, if you have some comments on things we talked about, or sometimes we get to rolling and we assume everybody know what we're talking about. If you have a question, please put it in the comment box and we definitely will address that. So with that, I'm glad we got that out the way, dope. So how are you doing today, man?
Absolutely fantastic.
Oh, absolutely fantastic. Okay, I like to hear that, man.
Really blessed, my brother.
Oh man, well you know the secret, man, because there's a lot of things going on and people are so stressed these days with uncertainty and so much white noise in the atmosphere. But one of the things we focus on and one of the things we believe that can help you deal with a lot of things that's going on today is get understanding your finances. That's so important. Personal money management, so important. Like me and Dote said, it takes work, but we always like to start at the top talking about the stock market because that drives a lot of things. And who better to talk about the stock market than Thomas Doty?
Thank you, my brother.
So, what good news?
No good news, man. No good news. It's been a up and down week. The S&P has lost three losses, 3 days in a row. Just hasn't been real good. But you can see it's about flat for the past week. Hasn't really done much. Still up 13% for the year, which is very good. The NASDAQ is also slightly down, but it's up 16% year to date. And Microsoft it followed the overall NASDAQ, didn't do much this week, down $1. Apple had a really good week, and that's on the basis of the fact that they've told all of their suppliers for the iPhone 17 that they needed to crank up production, which is leading the analysts to believe that phone sales are doing better than expected. Doing pretty good in Asia. You can't just walk into a store and buy one in Asia, so that bodes well for Apple that the 17 is doing quite well. Nvidia's up a couple of bucks for the week. You see year to date, it's up 33%. Google has been rolling the last month. Probably was some profit taking this past week, but it dropped 5 points for the week. But for the year to date, it's up 30%. Pfizer stayed flat for the week, hasn't done much. Kind of expected it to drop a little bit once all the COVID mandates came down, that it's going to be a little difficult for anybody to get a COVID shot, but it's hung in pretty well. Palantir went up a couple of bucks. It's up 136% for the year. And United Health, I don't know if you remember, but last week it had a nice drop, but this week it's up 11 points. And this is down year to date 31%, but I got in at 301. So I am smiling. I'm up 45 points on United Health, and I expect it to do better. If you look at what it closed the end of year 2024, it was up to 504, and it was actually up higher than that during the year. So I'm expecting to get some of that back. It's the biggest healthcare company in the country, and I expect it to do well. But things are still up in the air, volatile. There's a lot of good news coming in, a lot of bad news coming in. The Fed is still expected to drop interest rates a couple of points, but there's still some sluggishness in the market that's kind of scaring some people. Tariffs haven't hit their full stride yet, so we don't know how that's all going to shake out. So it's going to be shaky towards the end of the year, and historically, September and October have always been pretty tough months for the market. So it remains to be seen how the rest of the year is going to shake out. I'm going to hang in. I'm not selling anything right now because I play the long haul. So I'm going to kind of hang in where I am. And just before we get into Bitcoin, well, I'll let you do Bitcoin. I just wanted to mention something on those REITs that we talked about before, Bob.
Okay. I just want to say on the gold is up to $3,700 an ounce. It was up higher than that, about 3,800. I say it's on its way to 4,000 an ounce, the highest that has ever been. Silver is up at $45 an ounce, and I mean it used to be at $16 an ounce around about 2017. So that's.
Do you have silver, Bob?
Yes, I got I have silver. I have about 70 ounces of silver.
And do you have the actual silver, or do you have a fund?
I have physical silver in the safety deposit box.
Cool.
And actual physical gold too. I'd gotten them at the same time from Asset Strategies in Bethesda, Maryland. I just wanted to hold on to the gold for some. And when I first started getting into gold, but like I see now, having a gold fund is much more liquid than holding gold physical. But it's still good to have it, you know. And so let's talk about cryptocurrency. Cryptocurrency is taking a big hit. The whole crypto market went down from 4 trillion to 3.8 trillion. It's down $347 billion, down 8%. So that also means that a lot of the actual big cryptocurrency is down. Bitcoin is down 6%. It's down from last week. It's down $7,000 and some change. It's down to 109,653. That's still pretty up there, but it's down 6%. It's Ethereum, the smart contract crypto is down 15%. It's down $678, down from $4,582 to $3,904. Now, believe it or not, Ripple was actually moved up into third place, but now Tethered, which is a stable coin, which is pegged to the dollar, it has moved up to third place, and Ripple has dropped down. It's about 10% down. It's 31 cents down. It's down to $2.76 now. Binance still holding the fifth place at $950 of cryptocurrency, and Solana is still holding at sixth place, and that's dropped 20%. I don't know what happened to that, but that's down from $245 to $196 of cryptocurrency. That's down 20%. So don't know what's going on with Solana, but and though for people who may be interested in it's amazing our president has a coin out there with, I guess, his family, Trump coins. He's got about Trump coin, Mega coin, and they all are down like 72%. I think the Trump coin one time was at $47. It's down to $7. And the Mega coin was at least about, I don't know, maybe $17. It's down to like about 11 cents. So somebody got grifted on that. But they got a new one called the Liberty coin that's out there that they touting, and people have been dropping beans in there. But still interested in the president. What is it called? The monumental clause. But anyway, just want to let you know, because I know people have been hearing about Trump coins and stuff like that. But like with any cryptocurrency, it's highly speculative. You must be really, really, really conscious and mindful in dipping into cryptocurrency, because it's so volatile. And we suggest don't put money that you really need in there. And that's crazy, because people say, you need every money, but no, listen here, but
you say it a little bit different, Bob. That's something you put in for the long term, realizing that it's extremely risky. It may have a high reward, but it's not something you want to put the bulk of your portfolio. You wouldn't want to put a large amount of your portfolio in that.
And so let me put it this way: don't put money in there unless you're willing to lose it, or you can take the hit on losing. Let me put it that way.
Well, not necessarily lose it, but there's a chance that it may lose its value. Very few investments go to zero, okay? But it would not be surprising for Bitcoin to drop. It could drop 15, 20, 30%. But chances of it going to zero are probably slim and none. So you've got to be willing to take a loss because that market is extremely volatile.
Well, let me change the statement then. So don't put money in there unless you are willing to take a loss.
That just sounds so negative.
It's the truth, I don't put money in there.
It may go down in value.
Okay, let me change the statement. This is better. Don't invest in cryptocurrency money that you can't afford to lose. Is that better? No. Okay.
And I can't afford to lose no money, but again, the riskier your investment, the higher probability. Risk and reward work inversely. The more risk you take, the higher reward. So that's one that you could have a high reward, but you could also have a loss on your investment. You just got to be willing to accept that. So that's not something you'd want to invest in with money that you may need in the short term, because it's very volatile and may be down in value. So I think you guys got the drift of what we're talking about.
Modestine said Elon Musk has come out with a cell phone. I didn't know that, Modestine.
Oh, I didn't know that either.
All right, the Musk phone. Yeah, okay.
Something we talked about a couple of weeks ago was REITs, and somebody was interested in investing in those. And that's a really good investment, especially with our topic tonight of interest rates going down. But that's just a way to get into the real estate market without being a landlord or even a homeowner.
What do they stand for, though? REITs stand for?
Real Estate Investment Trust.
Right.
And so that gives you an opportunity to invest in single-family homes, commercial buildings, mortgages, And so you invest in a trust, your money is pooled. Now, the interesting thing about those is they don't pay any income taxes. And so that's why the dividends on those things are usually a little bit higher. Where it gets a little tricky is the taxation on those things. And that's where you really have to, if you're using TurboTax or a tax cut or something like that, it'll be able to handle the tax situation. But if you're doing it on your own, it's a little bit tricky. So just make sure you pay attention to how that income is taxed, because you don't get, like we always talk about, if you have qualified dividends, that's dividends in most companies like Microsoft or Apple. Dividends you get from those companies, you get a tax break, as I think it's 15% that you don't pay tax on. But dividends from REITs, you don't get that break, but part of their return is considered capital gains, in which case you get the capital gains tax. So that's just something you have to pay attention to if you invest in real estate investment trusts, that the income tax on those things are very tricky. But now is a good time to get into those. And I think I'm actually going to start looking at one to drop some money into.
And I like to reiterate the point, audience, that especially people who are close to retirement or in retirement that think that it's too late to be investing. And we live in longer, at least, 15, 20 more years. And with the way inflation is going and the cost of goods and things like that, your savings could be eaten through dramatically. So you need to increase your return on your money that you have. And that's why we always talked about different investments, because I've talked to some people and they're like, well, Bob, I missed out. I wish I would have. No. It's never too late to invest. I just want to reiterate that for some of you all that think you missed the boat. No. These different times, we live in longer, and you're going to be needing your money. Your money need to be long. You need more money at the end of the month instead of more month at the end of the money.
Have to do
it. So, hey, Dope.
Yes, sir.
The Fed dropped the interest rates like they've been talking for the longest, and threatened to do more of those. Let's talk about what's the whole thing about interest rates. How does that affect people?
Yeah, it could be good news for your wallet, depending on where your money's invested and what you plan to do in the near future. And in the latest cut, we talk about the Fed cut the rates. What rate? Well, they cut the federal funds rate, and they expect to do it a couple of more times before the end of the year. And so that lowers borrowing costs and it opens new opportunities for consumers. And so you could have cheaper mortgages. Hopefully you can maybe get lower car notes. Your credit cards can go, interest on the credit cards can go down. And so that should put some more money in your pocket and allow you more money to invest. Hopefully you do that strategically. Okay, so what is the federal funds rate and why does it matter? Well, that rate is the interest rate that banks charge each other for overnight lending. So, but its influence stretches far beyond Wall Street. When the Fed lowers the rate, borrowing tends to get cheaper across the board. From mortgages to car loans, credit cards. That's why that's why a federal funds rate cut can be a big win for your wallet.
And that's why we want to talk about some of the moves to make since they have dropped the rates and considering dropping the rates a couple more times, before the year is out and definitely into the new year. So the change in the federal funds rate, it ripples through the economy, changing rates for everything, like Doe said, for auto loans, even for businesses borrowing. Now, it usually takes at least 12 months for the change to have a widespread economic impact, but the stock market response is often more immediately. Simply put, the Federal Reserve changes the federal funds rate to discourage inflation. By increasing the federal funds rate, the Federal Reserve is effectively shrinking the supply of money available to borrow. So things get tight because people just out there spending and jacking up credit. And the reason that's why, they make it, they make the credit easy because you may not have the cash, but they make the credit lower the rates so you can be able to purchase more items. But when the Federal Reserve decreases the federal fund rate, it increases the money supply. Now, this is encouraging spending by making it cheaper to borrow. Now, the Federal Reserve, the nation's central bank, I know y'all have heard that, changes its target interest rates to keep the economy at a healthy rate. It raises rates when the economy is too hot, meaning a lot of spending is going on, big spending is going on, and threatening to raise inflation, where the cost of goods started going up in 2 minutes. So they try to do balances. So if lower rates when the economy is sluggish in order to boost activity to help a healthy level balance. So basically, let me just put it like this: interest rate fluctuations like a spending game. When people go over the top, spending too much, they try to slow down the economy. Then if people not put money back in the economy, they lower the rates so people can purchase more things to help. So there's always a balancing act. And to me, it's like a spending game. But today, we're going to discuss a few moves you can make when the interest rates drop.
Well, the first one I'm going to talk about is refinancing a mortgage. That's the one that can create the most bang for your buck. So lower rates can make home ownership definitely more affordable, whether you're already in a home or whether you're shopping for a home. Why it matters? Well, mortgage rates have eased from their peak rate of 7.73. They've dropped to about 6.23 as of September 18th. And that shift means millions of homeowners could refinance and save. And it's also good news for buyers. So how it works, the Fed doesn't set mortgage rates. Okay, they have nothing direct. They're not directly involved with mortgage rate, but its decisions influences them. So when the Fed cuts short-term rates, it often leads to lower yields on treasury bonds, which mortgage rates tend to follow. And so how does that affect you? If your current rate is above 6.5%, refinancing could save you a couple $100 each month. A quick example: if you had a $400,000 loan, dropping your rate by 0.75 of 1% could mean $200 more in savings. That's in your pocket. So home buyers, their lower rates can boost your buying power. It can allow you to buy a little more house, reduces your monthly payment. It's easier to qualify with the lower interest rates. So a 1 percentage point interest rate drop from 7 to 6 could mean getting a 10% larger mortgage for the same price. But when you think about refinancing or buying a home, just remember there's other things involved in that purchase. You have closing costs. You could have long-term changes, how long you plan to stay in the home. All those things factor in making that decision. So refinancing isn't always a slam dunk, but it could mean real monthly savings for you.
Yeah, that's true talk, though. Now I want to talk a little bit about how falling rates could help you finance a car without stretching your budget. Now auto loan rates have been historically high, with the average annual rate, the APR, for new vehicles at 7.6% as of May of this year. Now, to manage monthly payments, more buyers have been stretching their loans. Like about 24% of new car shoppers now opt for adult 84 months, loans. That's 7-year car loans, the longest term available now. While lower monthly payments, can lower your payments, it can lead to paying thousands more interest and actually staying upside down on the loan longer. Say that 5 times real fast. The Fed rate could help reverse this trend. making shorter term loans more affordable. While auto loan rates don't move in lockstep with the Fed rate, they do follow the long term bond yields and the broader economic conditions. So let me put it like this. When the Feds cut the rates, it's previously led to lower rates on bonds and cheaper credit. And that way you can, it brings down auto loans and the APR, because you should always look at the APR, not the straight interest rate. Because sometimes straight interest rate is just that, the flat interest rate. But you look at the APR, the annual percentage rate, which has factored in there other things like all the other things, fees and penalties and stuff like that. Now, when you're looking at this, try to avoid overly long loans, because I know a lot of people like to see those 84-month loans, 6-month loans, because you get lower monthly payment, but a loan of no more than 60 months, they say, can make sense if you can manage it, because longer term offers often higher total interest rate and slower liquidity buildup. So pre-qualify with multiple lenders too. Don't just go to one lender and you see a rate that looks attractive. Go to several, and when you're looking for a car loan, they'll let you for car loans and mortgage loans, they'll let you look at multiple and pre-qualify for more, because they know that you're just looking for a better rate. It's not that you're looking for a credit card so you can, because other credit cards you're maxed out. So compare the rates and the terms before you commit. And consider refinancing if you already have a high rate loan on your car. Lower rates may open the door to better terms. So let me give you a little tip. The shorter the loan term, like 36 or 48 months, can save you money over time and help you build equity faster. In many cases, shorter loans may come with a lower APR, believe it or not. So you might get a lower rate. Though a longer term loan may seem less expensive on a monthly basis, the cost adds up over the year. Let me give you an example. The average car loan now amounts to, and this is amazing though, $42,000. Even small differences in interest rate can really matter. For instance, if you had a $42,000, if you borrowed that for a car for 48 months at 7.6%, this could leave you with a monthly payment of $1,015 a month. Good Lord. The total amount going to interest over those 4 years is $6,800. Now look at a 72-month loan term at 7.6. That brings the monthly payment down to $730. But check it out. But that will cost you over the term $10,000 as opposed to a loan at 48 months would cost you $6,800 in interest. Now, even a small rate change can help you save money. Let's say a 48-month loan at 7.1, down from 7.6, would lower your monthly payment slightly to about $1,005 per month. But check it out. Over the life of the loan, that's $600 less over the life of the loan. So the little change, a quarter change, half a percentage point change can make a difference.
Hey Bob, let's jump on the subject we talked about this weekend with Clutch. A lot of some people are reluctant to refinance because they're in their mind, okay, I buy this house, I get a 30-year loan. I'm in the house for 5 years, I got 25 years left, and I refinance and another 30-year loan. So now I got to pay for it for 5 more years. So I would have been paying for that house for 30, 35 years, the original 5, and then when I refinance, 30 more. But the smart way to handle that is when you refinance, you don't have to take another 30-year loan, okay? The lower interest rate is always what you are after. You are always better having a lower interest rate. But your term, you can determine how long your term is. So in the example I just gave, if you paid 5 years on the loan. You can refinance that loan at 25 years. Okay, it's even smarter. I think, Bob, you actually said the shorter the term, the less interest you pay. In a lot of cases, the lower the interest rate. And the interest rates get lowered because the lower the term, the less risk is involved.
I know, and that it's
What? What'd you say?
I said that's so interesting that people don't look at it that way.
Right. And so just because you refinance doesn't mean you have to keep the same number of years. You should always be looking to lower your interest rate and lower the number of years you have to pay, because that's going to, in effect, lower the cost that you're paying for using that money. Now, make sure you can afford it. And I've always gotten 15-year mortgages. And again, when you get a 15-year mortgage and you make a payment, you can see your principal amount drop. When it's 30 years, most of what you're paying at the beginning is just interest. So at least take a look at it, see if you do refinance, see if you can take a shorter period, 25 years, 20 years, 15 years, 10 years even. If you can swing it off and lower your debt service, lower the amount you pay in interest by taking a shorter term, okay?
And though, let's talk about some of the things you might need to factor in though, if you are refinancing. And I know you mentioned it, but I want to reiterate it. That some of the things you need to consider is the closing costs, the loan term changes, and how long you plan to stay in the house. It's those things you really need to look at, and things that need to be done in the house too. So there's you just don't need to jump out there and just look at rates. There's other things in making that decision you should consider.
Yeah, the rates are very important, and you can lower your payment a bunch, but don't just lower your payment and take that money and use it frivolously. Use that again. Lower your term, and you might end up keeping the same payment, but you're paying over less time. That's going to lower how much you're paying in interest. Okay, let me move on. The next thing you might possibly do is pay down credit card debt faster. If you have a balance on your credit cards, a small drop in rates could save you a little money on interest. It's always a good idea to pay down high interest rate cards first. You always pay your high interest rate card first. That should be a standard principle. But a rate cut could help free up some money that you could put towards your balances if you do carry a balance from month to month. And so the bigger opportunities to save money come from consolidating loans and maybe looking for a lower rate, possibly at a fixed rate, if that's out there for you. So take a look at all those scenarios. And so, when the Fed cuts rates, credit cards rates tend to follow, but they don't follow by much, and they tend to follow a lot slower. And a lot of times you may even have to ask, and you may have to go out and find another credit card or personal loan or something with the lower interest rate, because it's like when interest rates go up, they're very slow to raise them. When interest rates go down, they're very slow. I'm sorry, when interest rates go up, they're quick to raise them. But when they go down, they're very slow to make changes. So you may have to do some work yourself and go out there and find that lower interest rate in order to lower how much you're paying in interest. And it's crazy. The average credit card APR was 22.25.
Whoa.
Man, that's you paying 22% interest. Just like we say money doubles, the rule of 72s, that means your debt doubles also in like 3 years if you're paying 22.25. So the interest rate a credit issuer may offer, it varies by your credit score. Always work on improving your credit score. The higher your credit score, usually the lower interest rate you're going to have. So it's all about taking care of your credit, managing your loans, finding that lower rate out there, because you may have to search for it. nobody's going to call you up and say, hey, we got a lower rate, we'll give it to you. And so people who carry a balance stand to gain the most. A lower APR means more your payment goes towards principal and not interest. And so if you consolidate, you may find a better term on balance transfer offers or personal loans, especially if lenders pass along the rate cuts quickly. So credit card issuers may also sweeten rewards to attract new customers. They're always trying to get new customers. A lot of times people just don't take the effort to look and I've had this credit card for X number of years. Don't matter how long you had that credit card. If it's not the best interest rate for you or the best reward, go get another one. Get a better one. Always try to improve your positions. So as I said, rate cuts don't always translate to immediate APRs. And a lot of the variable rates, they're tied to the prime, which moves when the federal fund rate, but issuers can still adjust their margins whenever they want. So be aware of that. Even if the prime rate drops, your total APR might not fall by as much, if at all. That's all up to them. And again, you may have to go out and find that lower rate, okay? So if you're looking for a new card, don't just look at the APR, but also look at the fees, look at the rewards, what kind of introductory offer are they giving you, what's their balance transfer rate. There's a lot of thought that should go into that decision. It's not just looking at the rate, look at the whole ball of wax. So if you've been putting off a balance transfer or a debt payoff plan, a rate cut could be the nudge to get you to act. You may be able to lock in a lower rate on a personal loan or a balance transfer offer, which could help you pay off your debt much quicker than it would be with the higher interest rates.
Hey, Doug, can you just for a minute spend a little bit more time? How do you feel about that balance transfer option?
Well, again, I actually used those when I had 2 kids in college and 2 kids in private high school. I'd be waiting for my bonus check or waiting for my stock to come in or waiting to sell some stock. And I would use a balance transfer check. And at the time, a lot of the credit cards were not charging fees or were charging very, very low fees, like 2%. Now, you have to really be on top of things because you have to pay that back before the date they give you, or a lot of times they'll go back and hit you for the higher interest rate for the whole period. So whenever I would take out one, I would always put a date a couple days before the deadline on my calendar to make sure I paid that sucker off before it went to the higher interest rate. But a lot of times I've seen fees as low as 2.99, 3.99, and it might be a year with no interest. So if you're paying the interest rate that's higher than that 2.99 to 3.99, and you can pay that balance transfer off before that offer ends, you're obviously in much better shape to do that, and it would help you to do it. If you're paying at 8%, or if you're paying 22.25, and you can do a balance transfer and pay a 2.99 fee, that's really an interest rate that you're paying. You're way ahead. Instead of paying 22.25, you're paying that 2.99 or 3.99 interest rate. But again, you have to have the money to pay it off before that deadline. So if you use it wisely, it can be used effectively.
And I just want to address another approach that you said, which you sort of characterized as called the avalanche approach, where you pay off the highest. Did you say the highest interest rate or the highest balance?
No, you always pay the highest interest rate off first.
Right. Because now there's some financial planners that suggest, like, some people have like some big balances on those high interest rates. Like, say they got like about $15,000, paying 20-something 2%. And now they sometimes use an approach of the snowball approach where say you have a balance of $1,000 on another credit card, even though the interest rate could be like maybe 17%. Sometimes they're saying to some people keep paying on the bigger one, and they don't seem like they digging into the principal or getting ahead. So they talk about the snowball approach sometimes, just pay off the smallest balance so you can feel like you're making some leeway psychologically. But that's just another approach.
But the other thing with paying off the smaller balances is you take that money that you were paying on the smaller balance and apply that to the next one.
Right, exactly.
That's the advantage of doing it, yeah.
Yeah, but I just wanted to share that too. Yeah, so the next thing I want to talk about is the adverse effect. The Fed's lowering the rates help, borrowing, but it also sometimes lowers the rates on savings. And so you need a different strategy to make sure you get a better yield, because it has an adverse effect on lower risks, like high yield savings accounts and money markets and CDs, right? And high yield savings accounts have been offering relatively high yields. They were up as much as 5-6% at one time a year ago, but these rates may fall to the Fed cut. So it could be a good time to reassess where you keep your cash, especially if you're looking for stability and still you want a yield, right? So, with rates, poised to potentially trend lower, now may be the time that you can look a little bit, you may look at how your cash is working, like we talked about the other week. Now let's talk about the first one, money market funds. These funds invest in short-term, high-quality debt, and they typically offer competitive yields with daily liquidity, and that's usually based on $1 asset value, the net asset value. And what happens, the yield is what fluctuates, so the return. But the Fed's interest rate policies will affect money markets, and the rates could be lower than what they were a month ago. Another one we all know about is CDs, right? If you don't need immediate access to your cash, locking into today's rates, and the rates right now, I'm thinking about you can get a high 4 percent on high yield CDs.
Not for long.
And that's a smart move. It offers fixed returns over a set term, which can protect you from future rate declines. And then, they have the CD ladders where you buy CDs and stagger the maturities. And that can help, you stay flexible and still capture the yield. So a CD ladder is like you might get a 6-month CD that locks in at maybe 4.7, and then you might get a 1-year CD that locks in at a little bit lower, because the longer term, they usually the lower the rate they give you. But you can that's a CD ladder, or get a 2-year and just statter, so all your money isn't locked up at once. That's what the CD ladder helps. Then you got short-term bonds and then bond exchange traded funds, ETFs. Now these funds invest in bonds with shorter durations, which tend to be less sensitive to interest rate changes, because usually long-term bonds are sensitive. When interest rates go up, stock market go up, bond prices go down. So that's usually how it works. And you can, a balanced yield and a stability, but bond prices move in the opposite direction, like I said, and so does the bond ETFs. You can see the price appreciation. So on those type things.
Hey, Bob.
Yes.
And that was one I had a hard time grasping.
Okay.
Studying that in school. And the way I finally figured it out is if you got a bond, let's say you buy a bond and it pays a 5% interest rate.
Right.
Okay. So if interest rate goes up, that means the bonds are now paying, let's say 6%.
Right.
So why would I would have to pay less if I'm selling a bond that pays 5%, if bonds now are selling 6%, selling at 6%. And the same works inversely. And that was the only thing that allowed me to understand that relationship. So I hope that makes sense to you.
Yeah, because because that means they're going to be discounting the. It makes sense that the ones paying 60% is going to be given a high yield, so the one at 5% is not as attractive, right?
So yeah, you got it. The price of it has to go down, so the interest rate payment that you get will be equal to the bonds that are on the market today.
Yes. That's how it works. That's when they talk about the inverted relationship between interest rates and equities and bond prices. Now, the things to consider you all and always is for these particular vehicles, liquidity. Money market funds, and short-term bonds offer easier access than CDs, which typically lock your money up, for months and years. But you can also get into what they call brokered CDs, which sometimes offer you the ability to sell your CD before the term is up. I wouldn't suggest, but everything has a place in your portfolio depending on what you're trying to do. Now, the rate outlook, if you're concerned that rates may fall further, locking in yields now on CDs, it makes a lot of sense. Now the risk tolerance, well, all three, those options I told you about, CDs, money markets, high yield accounts, and ETFs. They relatively low risk. Bond funds and ETFs can fluctuate and vary. Now, to give you a little tip, even with lower rates, accessible accounts like savings and cash management accounts are still a good place to put your money for emergency savings. Like if you need money in the next, 6 months within a year. So, putting it in a traditional savings account or a cash management account, as some of the brokers have, that still has a place for that. But for cash you don't need right away, exploring alternatives I told you about can help you earn more while still staying aligned with your goals of, earning more and keeping a stable risk.
Okay, Bob, let's wrap it up.
Okay, yes, let's do it. And just remember, rates can have an impact so much. So, dope. Let's go to, let me get my banner straight here. There's a lot going on there. All right, dope. Let's go to the video. We talked about a lot like we always do, and we like to recap. Tell you what we told you, then tell you what we told you. All right, I'll go first, though.
Okay.
Lower rates can create opportunities. And that's the thing that we want to talk about, the moves that you can make because the rates have dropped. So make sure you're paying attention. Make sure you are being aware so that you can take these opportunities, because low rates can save you, especially with debt, and low rates can help you if you use them correctly in the high yield vehicles, securities.
Look for ways to lower your debt service. That's a cost that you pay that you need to find a way to lower. With interest rates going down, the amount you pay in interest should be going down, whether it's refinancing your home, looking for a lower credit card payment, looking for a lower personal loan, consolidating your loans to get a lower rate. Find a way to pay less in interest and take that extra money that you save and use it to pay down your total debt.
Next one is optimize your interest revenue. And this is what is so important when I was talking about, the lower risk liquid type of ones. And the key is this, to make sure you are aware. And we always talk about there's so much information out there that you can get. And the key is to increase, your bottom line, optimize your interest revenue.
And finally, you need to understand that interest rates impacts wealth, be it how much you earn in interest, whether it's how much you pay in debt. If you're paying in debt, that's money that you don't have to invest. That's an albatross around your neck. If you're paying 22.5% for a credit card loan, or if you're paying more than you should be paying on your mortgage, if a car loan, if you're buying more car than you need and carrying a 72-month car loan, those things all impact your total wealth. Best thing you can do, lower how much you pay in interest, maximize how much you make in interest. And it's like we always talk about, every transaction you make, every financial transaction that you make, you need to look to maximize it, whether in paying as little as you can and earning as much as you can. That's the way you build wealth.
That is so true. Joanne said, thank you for another great show. And Modestine said the same thing. Thank you. Roll call, dope. My wonderful sister Nolia and Gloria are on. I don't know where Linda is today. Where my Linda's gone. But I see my sisters, and Gloria's birthday is coming up. My sister Gloria's birthday is this Tuesday, September the 30th. So happy pre-birthday, Gloria. I'm not going to tell you you're going to be. That's how. And Melody's birthday is the 29th. Melody's birthday is 29th. Melody will be 22, my daughter. Modestine, Lexington, South Carolina's finest. Thank you for your comments. And the wonderful, the incomparable, now Dodie. So glad that you're with us now. Thank you for your support. And my little brother, Carl Chapman. Carl, man, dope, hooked me up with a Wilt Chamberlain t-shirt. Remember the Wilt Chamberlain t-shirt I wore last weekend?
Oh, yeah.
That was Carl. He got that for me, man.
Oh, cool.
And it says, legends never die. That includes
we know it had to cost a lot of money because it had to be big.
Oh, you always get those little jokes in. I'm glad I'm
little. Nothing little about that.
I'm glad I'm not sensitive.
Little.
Joanne Skinner, always a winner. Joanne, glad to see you. And ladies and gentlemen, Rodney L. Madison Sr., the NoteExperience.com. Go out there.
Rodney.
What's up, Rodney? Go out there and learn about another investment vehicle. Garnett Nickens. What's up? Garnett Nickens, always good for the pickings. Always good to see you, Garnett. And that's everybody.
You should have been a TV show host.
Oh, yeah, right. But look, this might come out of me. So, the quote of the week. Stop asking the clown, why is he acting like a clown? Ask yourself why you keep going to the circus.
I like that. That's a good one.
Yeah, that might apply to me. I'm like, damn, the Lord put that up on me today. I'm like, oh, God. Stuff anyway, y'all. Thank y'all for tuning in. 215th show next week, dope. And we coming with you with some more information. Make sure you share this information with other people on Facebook, and make sure you go out there and subscribe. Tell more people you are. We want to get our numbers up to 1,000 followers. So far, we got approximately 500, and we're glad to have that. So thank you for tuning in, and we see you next week. Oh, did I forget Nolia? My sister Nolia.
No, you said.
I said Nolia. I'm sorry, Nolia. Great show. I forgot about Nolia. Hey, Nolia. See y'all.